Hi everyone, welcome back to our next video. In this video, we would be covering a crucial concept which is called liability. So let's get started. Liabilities are your debts, financial obligations, or burdens which are to be repaid by the business. Now, these are not good things. These are burdens, obligations which have to be repaid. Now, remember, just like assets, there were two types, non-current and current. Similarly, even in liabilities, there are two types, non-current liability and current liability. The concept is very similar to the non-current and current assets. Like in non-current assets, they were assets held for more than a year, if you remember. Same goes for the liabilities. So non-current liabilities are those debts which have to be repaid after a very long time, generally more than a year. Now, most commonly, there are two examples of non-current liabilities. Number one, long-term loan. Now, long-term loan is a loan which is generally paid over an extended period of time, minimum after 3 years, 5 years, 10 years, and it can even stretch up to 20 years. The amount is also massive. It's used for long-term purposes, such as buying non-current assets or for investments. There's another very common example, which is called debentures. Now, debentures, we would cover this later in the company accounts chapter, so I don't want to confuse you all. Now, let's move on to current liabilities. Now, before I move on to current liabilities, I want you to recall the definition of a current asset. Now, current assets, if you remember, it's expected that the economic benefits would flow in the business. They would generate economic inflows. So now these are debts, obviously, current liabilities are your debts. So these would create outflows. It's expected to create outflows. These are debts or financial obligations which have to be paid within 1 year, same as current assets within 1 year. So even the current liabilities have to be paid within 1 year. The difference is these are outflows, current assets are inflows. In other words, the economic benefits, cash, is expected to go out of the business within 1 year. Now, there are some very common examples. Some are technical. We would cover them in detail, and some we'll cover later on. There's payable, bank overdraft, accrued expenses we would cover later on, and prepaid income we'd also cover later on in the accrued and prepayments chapter. So let's understand what payable is. Now, again, I will give you a short scenario. The person you see on the screen is John. He's the owner of the business. Now, John bought goods worth $100 from Emily. So Emily is the supplier and John is the business. And John bought goods on credit. Now, I hope you understand the word credit. I explained this in the current asset chapter. So now let's assume that Emily is John's supplier for years. So based on that relationship, John made a request. Can I take the product now and pay next week? Now, Emily acknowledges the fact that John is a loyal customer. She says, okay, I don't have a problem. Now, let's understand the scenario from John's perspective. Now, John owes Emily $100. All right? John owes Emily how much? $100. So John is Emily's credit customer, and now John has an obligation to pay $100 to Emily. All right? Obligation to pay. The word pay comes from payable. In other words, Emily is John's payable. So Emily is the liability of John. He has a debt of $100. All right. So this is what payable is. Payable is your credit supplier to whom you owe money. Now, I want you guys to understand one thing. This general rule would always apply. One party would always be the payable. Now, if I talk of John's perspective, Pause the video for a second and tell me, what is Emily? Is she a payable or a receivable? Right. From John's perspective, Emily is the payable. Why? Because John has to pay Emily. From Emily's perspective, who is John? Emily sold goods to John, so Emily has to receive the money from John. So John is Emily's receivable. So always remember, one party is the receivable, the other party is the payable. So this is the concept of payable. Now let's move on to bank overdraft. This is also very important. Now let's assume John has $10,000 in his bank account. Well, sounds pretty good. He can go for holiday. Anyways, the problem is he's paying a crucial expense, a very crucial expense of $11,000. He only has $10,000 in his bank account. Would he be able to pay the expense? Yes or no? Yes, he can pay the expense. Now, he has 10,000 in his bank account. The bank would allow him that, okay, fine, we will pay the extra expense. You can pay us later. So he paid $11,000. Now his bank account would appear as $1,000 negative. Now, in accounting, whenever we show a parenthesis, it means it's a negative balance. Always remember that parenthesis means a negative balance. So this is a bank overdraft. When you withdraw an amount more than your limit in your bank account. So John overdrew $1,000 from his account, and now he has to repay it to the bank. So a bank overdraft is a temporary loan that allows bank customers to continue paying bills or withdrawing money even after their accounts are empty. So this $1,000 is another debt that has to be repaid by John. So this is a liability. That's it for today's class. In the next video, we would be covering some other crucial concepts. See you tomorrow. Thank you very much.